Hey everyone, it's Iggy from the Investing Iguana. If you're a Singaporean investor or just someone curious about the latest moves in the SGX, you're in the right place. Today, we're taking a close look at OilTech International. What's got analysts excited? Why UOBK Haiyan just upgraded their target price? And most importantly, what this means for your portfolio. Stick around because I'll also share my personal take on whether OilTech is a buy, hold, or sell right now. First, let's talk about why OilTech is in the spotlight. UOBK Haiyan recently raised their target price for OilTech to 80 Singapore cents, up a whopping 65% from their previous target. That's a big move, and it's not just hype. It's backed by some solid numbers and a clear growth story. Let's start with the basics. OilTech is a leading provider of renewable energy equipment, especially in the biodiesel and sustainable aviation fuel, or SAF, space. They're based in Malaysia but listed here in Singapore, and they've built a reputation for quality and innovation over more than 4 decades. Now let's dig into the numbers. For the full year 2024, OilTech posted record revenue of RMB 30.3 million, up 14.5% from the year before. Even more impressive, their net profit surged 55% to R29.6 million. That's not just growth. That's accelerating growth, and it shows the company is executing well, even in a challenging global environment. Their gross profit margin jumped to 23.9%, up from 19.5% the previous year, thanks to higher margin projects in the edible and non-edible oil refinery segment. But here's what really catches the eye: OilTech's order book. As of February 2025, they have earned 355 million worth of orders in hand, nearly matching their previous record. That's enough work to keep them busy for the next 18 to 24 months, which means revenue visibility is strong. And with customers finally getting clarity on US tariffs, which had caused some to delay spending, OilTech is well positioned to win even more contracts as CapEx picks up again. Now let's talk about the industry. The world is shifting toward cleaner energy, and regulations are tightening. For example, Malaysia is increasing its biodiesel blending mandate from B10 to B20, and Indonesia is moving from B35 to B40. These changes mean more demand for OilTech solutions. Plus, the aviation industry is targeting net zero emissions by 2050, and SAF is expected to deliver 65% of the needed reductions. OilTech's expertise in processing vegetable oils for SAF puts them right at the heart of this megatrend. But it's not just about the macro picture. OilTech is also shifting its business model. They're moving into manufacturing, aiming to build recurring revenue streams. Think of it like moving from selling one-off projects to earning steady income from operating plants. And they're doing this in a capital-light way, reinvesting profits and taking minority stakes to limit risk. That's a smart move in a sector where big capex can be a trap. On top of all that, OilTech is considering a dual listing, possibly on Bursa Malaysia, which could boost liquidity and attract more investors. They've also applied to move from the catalyst to the main board of the SGX, a sign of their growing maturity and ambition. Now, let's talk valuation. UOBK Haiyan's new target price of 80 cents is based on a higher price-to-earnings multiple, reflecting OilTech's growth prospects and the potential for further contract wins. The stock has already more than doubled this year, so some might wonder if it's too late to buy. But with a strong order book, improving margins, and exposure to fast-growing sectors like SAF and biodiesel, the analyst thinks there's still upside. But here's the thing: no investment is without risk. Global trade tensions, supply chain issues, and changes in government policies could all impact OilTech's business. And while their shift to recurring revenue is promising, it's still early days. Execution will be key. So, what's my take? After going through the numbers and the analyst report, I agree that OilTech is a compelling story. Their financials are strong, their industry tailwinds are real, and their management seems focused on creating long-term value. That said, the stock has had a big run, and the market is pricing in a lot of growth. For me, this is a stock to watch closely. Maybe start a small position if you believe in the long-term story, but keep some powder dry in case we get a better entry point. If you're a long-term investor, especially someone building a portfolio for retirement or using your CPF or SRS, OilTech could be an interesting addition, but don't go all in. Diversify, stay disciplined, and keep an eye on how those recurring revenue streams develop. Before I wrap up, if you found this deep dive helpful, hit the like button, share it with fellow investors, and subscribe to the Investing Iguana for more in-depth analysis. If you want to get these insights even earlier, consider joining our premium membership. You'll get early access to all our videos, often a full week before anyone else, for less than the price of a cup of coffee. It's a small investment for a big edge in the market. And if you want to learn more about how to interpret valuation metrics like PE ratios and dividend yields, check out my other video. I'll leave a link in the description. Thanks for watching, and remember, investing is a marathon, not a sprint. Stay curious, stay patient, and I'll see you in the next video.